Okay, we're going to pick up with looking at the change in the common stock, the amount of money that's been paid to repurchase shares. So in this case, if we look at the common stock line item, there's been no change from 2018 to 2017. And so there's been no use of common stock, or no change in common stock, no use of funds to repurchase common stock. So the last thing that we can look at is the short-term investments. And one use of free cash flow would be to purchase short-term investments. But in fact, there was no purchase. If we look at 2017 and 18 numbers up here, there's been no purchase, but in fact a sale of free cash flow. So it wasn't a use of free cash flow, in which case it would have a positive sign, but instead it was a source. We got a negative sign there. And so it was a use of negative 40. So again, these signs are important because otherwise, when we add up all these uses of free cash flow, we're not going to come up with the same negative 260 that we came up with when we did the how free cash flow is generated back on slide 9. So it's important to have the signs correct, and in this case, when we stick all the appropriate signs on here, we come up with the uses of free cash flow, coming up with a negative 260. And all of this is saying that we had to basically get $260 million of new money to take care of all the investments that we were making in operating working capital and in net fixed assets. So this is closely related to the statement of cash flows, but it's a unique measure, and it's one that shows up a lot in finance and valuations and in other situations. So let's move on and take a look at some performance measures using free cash flow. So the first one is an important one, return on invested capital. And this is probably one of the first ratios that we are going to be talking about or looking at. And we're going to look at a whole bunch more in the next module when we look at different ratios, looking at profitability, debt ratios, asset management ratios, etc. So we're going to have a whole list of ratios to talk through. But this is one, and we're going to start off with this one, return on invested capital. It's defined as the relationship between net operating profit after taxes and operating capital. So the operating capital, just as a way of defining that, it's equal to the net operating working capital. We've already talked about that. And then add back in the net PP&E. So the sum of those two numbers represents the operating capital that's been deployed. So let's just look at these numbers here. The operating current assets, we've looked at this, but let's just sum up all of the operating stuff. We're ignoring the short-term investments, but since it's zero, we can go ahead and include it. We've got 1550 for the operating current assets. For the operating current liabilities, we're ignoring this line where the dash is going through, and so we're only looking at the 200 and the 300 for the accounts payable and the accruals. So our operating current liabilities is 500. So the net there, we take one minus the other. We've got 1,050 as the net operating working capital. We add in the $2,000 invested in net property, plant, and equipment, and so our total operating capital is 3,050. We look at the ratio of these two things, the NOPAT divided by the operating capital. We got 300 divided by 3050. It's 9.836%. Now, a quick comment. Just looking at a number by itself tells you absolutely nothing, or next to nothing. We need to have some context whenever we're assessing ratios, whenever we're comparing or thinking about numbers like this. So in this context, just by itself, that 9.836% really doesn't tell us much at all. Now, we really like to know, is that a good result or a bad result? Well, in this particular context, we want to think about two things. One, how does this compare to their cost of capital? So again, this is their return on capital, and hopefully they're earning something or getting a return on invested capital that's bigger than their weighted average cost of capital. So thinking about what WACC stands for, what it represents, it's really the average cost that a firm is paying to its suppliers of capital. So it's a rate, in this case, it's going to be 11% if we went through the whole example. But they're in effect paying or need to pay 11% return to the suppliers of capital to fairly compensate them for the risk that they're taking. It turns out in this example that they're only earning 9.836%. So here in a few more slides, we're going to see that in fact this firm is destroying value by not earning enough on their deployed assets to pay the required rate of return to the investors that are supplying the capital. So in this case, it's a bad number. We could also compare this return on invested capital to other firms in the industry. And as well, we can look at how has the return on invested capital been in prior years for this firm. So all of these are bases of comparison, and we always want to do that. We never want to just look at a number in isolation. Operating profitability is another number that we can look at. This is defined as NOPAT over sales. So if we look at the sales up here in the top right corner, we got 5,000 for the current year. Operating profitability would be 300 divided by 5,000. That's equal to 6%. Again, that means nothing in isolation, but if we found out that last year it was 6.93% and competitive firms are in the 8s, 8+%, that's the industry average. Okay, now we have some more information, some more context, and we could say, hey, we're going not only in the wrong direction, but we're also trailing all of our peers, and so this would be a poor result. Another ratio we could look at is the capital requirement ratio. This is defined as the net operating capital divided by the sales. So we've already looked at what that number is, 3050 divided by the sales of 5,000. We come up with this number, this ratio of 61%. Last year it was 53%, 53.21%. Now the question is that a good result or a bad result compared to last year? Well, you got to think about what this ratio is measuring. In this case, it's measuring the amount of capital you're tying up for every dollar of sales. So this year we're tying up 61 cents of capital for every dollar in sales. Last year we were only tying up 53 cents of capital for every dollar in sales. So we've had to invest in more assets for every dollar of sales. And so this would be a picture of inefficiency, of growing inefficiency. So in this case, a higher ratio is definitely not a better ratio. So again, always look at the context, think about what you're measuring before you decide if it's going in the right direction or the wrong direction. So higher is definitely not always better. All right, another important idea is the economic value added, EVA, and it's defined as the difference between the return on invested capital and the cost of capital. So we're going to take those two numbers, subtract the one from the other, and then multiply that across all of the deployed capital of the firm. So in this case, recall that there was a shortfall. We're kind of underperforming. We're not getting a sufficient return on the capital that we've raised, that we've got from outside investors. They're expecting an 11% return, and we're only generating a 9.836% return. So we are, in fact, destroying value. If we look at that shortfall, multiply it times 3,050, these are in millions, so 3,050 million. We have destroyed $35.5 million in this year. So we have lost economic value. We've destroyed wealth over the course of the year. So all of this is telling us that this firm has had a forgettable year for sure. Market value added. Here we're looking at the difference between the market value of the firm's stock and the amount of capital that has been supplied over the entire history of the firm by equity investors. So it's defined as the market value, which is equal to the shares, the number of shares that the firm has outstanding, times the share price. So we can look that up if it's publicly traded. So that product, we're going to subtract from that the total common equity. We're going to look at that up from the balance sheet, and that will represent all of the investment, the cumulative investment of equity investors. It includes, for instance, the retained earnings, which is all of the money that hasn't been distributed out to the equity investors, but it's been retained by the firm to continue operations, continue growing perhaps. But that's because that wasn't sent out to equity investors. It's in a sense reinvested in the firm. So if we look at that difference, hopefully it's going to be a positive number. That would be sad indeed if you had a whole history of pouring money into something, and then you looked at what the market value of your cumulative investment was, and it was less than how much you invested. That would be a dire result indeed. So that is the end of this particular slideshow. I'm going to start off with ratios and looking at ratio definitions and ratio analysis in the next set of videos. That's in the next module. So I will see you then.